Third is an online broker. A brokerage is a firm that acts as an intermediary between a purchaser and a seller. To broker a deal is to communicate with both the buyer and seller as to acceptable price on anything sold or purchased. A brokerage firm completes any necessary legal paperwork, obtains the appropriate signatures, and collects money from the purchaser to give to the seller. Interactive brokers and TradeStation are two options for brokerage firms. Fourth is a charting application. A charting application is a computer program that is used to create a chart based on the historical price movement of an instrument. A chart is a visual representation of data, in which the data are represented by candlesticks. Candlesticks are an illustration of the struggle between buyers and sellers. Fifth is the Infinity Trader method. The Infinity Trader method is a unique, dynamic, objective approach to the financial markets that focuses on price patterns. Price patterns make it possible to determine when to buy or sell a security for the purpose of making a profit. The Infinity Trader method will show you when, where, and why to buy or sell a security so you can be in control of your own investment decisions. In the following chapters, we will share with you our view of the financial markets that will change the way you trade for the better. Chapter 1 is Candlestick Analysis. A candlestick chart is the tool we will use to build our methodology. This chart shows us the movement of price over a period of time. Each candlestick represents the movement of price over a specified period of time. In any charting software, you can create these candlesticks in any time period. For example, a 1-minute chart, a daily chart, or a weekly chart. A 1-minute chart means each candlestick equals 1 minute of trading. A daily chart means each candlestick equals 1 full day of trading, and a weekly chart means each candlestick equals 1 full week of trading. Regardless of the time frame, the chart patterns will be similar. In fact, if you take away the time and price displayed on the chart, there is no way to know what time frame the chart is because they all look similar. The movement of price shows us the direction money is flowing and the commitments other traders are making. We are going to use this information to determine the direction prices are likely to move next. Each candlestick shows us the relationship between an instrument's open, high, low, and close. The high equals the highest price traded in that session. This is represented by a tail on top of the body. The high of the tail is the highest price traded during that period of time. The low equals the lowest price traded in that session. This is represented by a tail on bottom of the body. The low of the tail is the lowest price traded during that period of time. The body equals the degree by which that session was either won or lost. A candlestick with a large body was won more decisively than a candlestick with a small body. The open equals the first transaction that takes place within that session, and the close equals the last transaction that takes place within that session. A red bar indicates the opening price is at the top of the body and the closing price is at the bottom of the body, which means prices declined from the open of that bar. A red bar is a bearish bar, or the sellers won that bar. A green bar indicates the opening price is at the bottom of the body and the closing price is at the top of the body, which means prices advanced from the open of that bar. A green bar is a bullish bar, or the buyers won that bar. When analyzing candlesticks, think about how the current price is affecting traders who recently committed to a position. The bar at A closed at its high because the buyers overwhelmed sellers during that period of time. When this bar closed at its high, all of the traders who entered a long position on this bar are confident because they are all profitable with their position. All of the traders who are buying during this period of time have an expectation to make a profit from higher prices. The close of this bar is confirming their expectation. The greater price is retraced against the prior candlestick, the more potent it is because of how it affects traders' expectations. If the retracement against the prior candlestick is minor, prices have greater odds of continuing in the original direction. A small retracement does not affect enough of the traders who committed to the prior bar by causing them losses, and this increases the odds prices will continue in the original direction. The larger the reversal bar is in relation to the prior bar's body, the more potent it is because of the way it affects traders' thoughts and expectations. When traders' expectations are affected, it can cause an increase in momentum as those traders exit their position. The movement of price affects traders on both the long and short side of the market. This means prices advancing affect traders' expectations the same way prices declining does. The bar at A closed at its low because the sellers overwhelmed buyers during that period of time. All of the traders who were selling short during this period of time have an expectation to make a profit from lower prices. The greater prices retrace against the prior candlestick, the more potent it is because of how it affects traders' expectations. A small retracement does not affect enough of the traders who committed to the prior bar by causing them losses, and this increases the odds prices will continue in the original direction. The larger the reversal bar is in relation to the prior bar's body, the more potent it is because of the way it affects traders' thoughts and expectations. When traders' expectations are affected, it can cause an increase in momentum as those traders exit their position. Always ask yourself, how does the current price affect traders' expectations who committed to the prior bar? For a bar to be potent, it must penetrate 55% or more into the prior bar. Once a bar has penetrated greater than 55% into the prior bar, traders' thoughts or expectations begin to change. When traders' thoughts or expectations change, it causes a reaction for them to buy or sell, which is the only thing that moves prices. On pattern A, the green bar penetrates into the red bar about 20%. This level of penetration does not cause a lot of pain or shock for the traders who sold short the prior red bar. This pattern is not potent because a 20% penetration does not cause enough losses for the traders who sold short the prior red bar. On pattern B, the green bar penetrates greater than 55% into the prior red bar. This shows us traders who entered a short position on the red bar, below where the green bar closed, are holding a losing position. This affects their original thoughts and expectations about the future direction of prices. This will likely lead to those traders closing their position. The effect that a deep penetration into a prior bar has on the traders who committed to the prior bar is what makes a retracement of greater than 55% potent. On pattern C, the green bar penetrates 100% into the prior red bar. A retracement of 100% affects every trader who sold short in the prior red bar. Think about the losses traders who sold short at the low of the red bar are experiencing. They are holding huge losses and their original expectation has been crushed. This is the most potent pattern so far because it affects more traders who committed to the prior red bar than any of the prior examples. On pattern D, the red bar gapped down. This means the green bar closed at one price and the red bar opened at a price lower than the green bar closed. Any trader who entered a long position on the close of the green bar was immediately trapped in a losing position when the red bar opened. The red bar continued lower from the open and caused huge losses for any trader holding a long position from the prior green bar. Think about how this reversal affects traders' expectations who committed to a long position in the prior green bar. This pattern is extremely potent because the current price of the red bar immediately caused huge losses for the traders who committed to a long position in the prior green bar. Pattern E did not penetrate into the prior green bar at all. Even though the green and red bar are the same size as the green and red bar from pattern D, this pattern is not potent. The red bar gapped up. This means the green bar closed at one price and the red bar opened at a price higher than the green bar closed. Any trader who entered a long position on the close of the green bar was holding a winning position when the red bar opened. The red bar declined from its opening price, but it did not penetrate into the green bar at all. Every trader who entered a long position on the green bar is holding a winning position. These traders are not experiencing losses, so this pattern is not potent. In this example, there are two candlesticks. One is controlled by the bears and one is controlled by the bulls. These bars close strong with a large body, and the tails on top and bottom of these bars are small. A candlestick that has a large body and small tails was controlled and suggests continuation. When a bar closes strong, it increases the odds the next bar will continue in the direction of the strong bar. Let's assume the red bar opened at 50, then declined and closed near its low at 47. This increases the odds the next bar will continue lower. Now assume the green bar opened at 50, then advanced and closed near its high at 53. This increases the odds the next bar will continue higher. When the bears control a bar, the odds are prices will continue lower on the next bar. When the bulls control, the odds are the next bar will continue higher.